Welcome, everyone. This is Jason Martin at AllGen Financial Advisors. Today is March 28th, 2022, and wanted to give everyone an update on what's going on with the Russian invasion in Ukraine, and also what we believe is a great opportunity as we go into the future in international and emerging markets. So let's jump right in. So as we can see here, stating the obvious in this first bullet point with Russia and Ukraine is that we don't know the future. We don't know exactly what's going to happen. No one does, right? No one knows the future. But what we try to do when we're managing money is we try to come up with what's the highest probable outcome, so we can position the portfolio for that outcome and also try to protect and potentially grow the portfolio considering that outcome. So what we believe is the highest probable outcome is that Russia will potentially settle with just taking the regions in the southeast down towards Crimea, but basically providing them a land bridge from Russia towards Crimea. Obviously, we don't know that for sure, but Russia has come out recently and stated that that's now their primary objective. And so, we have to try to think about how does that factor into kind of the long-term results or even more short and intermediate term results of the market, and kind of more from a longer term perspective, which we believe is the more important thing to look at, is that that we will probably continue to have, no matter the outcome, Russian sanctions and repercussions from the West, which could potentially cause inflation to remain elevated for some time. So this is a slide I showed in the last market update, but it's worth revisiting because, obviously, especially those who watch the news a lot, there's a lot of fear around war, and, understandably, especially when it's war with a nuclear power. But I point out this chart because we always have to look at, what did the market do in the past when major events like this happened, and then what were the conditions around that time, what were the results. And so, if we look at all of this, all these different dates here, and these are basically major events, and what happened to the market afterwards. And let's take one of the worst case scenarios, this one right here, the Pearl Harbor attack. So the beginning of World War II for the United States, basically when the United States entered World War II. In the first month, the market was down 1%. Next 3 months, it went down further, and then it started to come back. And 1 year later, you can see that the market was up 4.3%. Also, there's a lot of talk right now about, or there's a lot more fear about the kind of Russia's using nuclear weapons. Well, there was a lot of fear of that back in the Cuban Missile Crisis as well. And you can see the market was very resilient and continued to go up in that time. Or one of the worst times in U.S. history, more recent times, I should say, was the terrorist attacks in 2001. And initially, the market did drop and immediately recovered. It was down a year later. We were also coming off of a time from the tech bubble where we were in a recession when that started. But if you were to fast forward another 1 year, the market had rebounded significantly after that. So my point in this slide is that while there is some short-term volatility when a major event like this happens, the market is resilient and tends to recover over time. So let's look at how the market's recovered this time. So in February 2024, that was the official date of when the invasion occurred. The market initially went down, but as you can see here, the S&P 500 is now up 6% since the invasion occurred a month later. In fact, this line right here, which is the zero line from when the war started, you can see that the market actually recovered within 3 weeks approximately. So the market is resilient a lot of times, and sometimes with initial fear, that actually presents an opportunity in the market as opposed to something where you should sell in a major event like this. So just wanted to point that out. Now, changing into the second point of this short update is that we want to kind of focus now on where we believe is an opportunity going forward, especially after this recent event, which has created another opportunity where if we look at emerging markets specifically, we're going to look at international and emerging markets together, but this particular chart looks at emerging markets. Over time, you have alternating time periods when emerging markets tend to outperform for a significant period of time, and that would be this time period really from kind of 2000 through 2011, where the emerging markets, when this line's going down, it means emerging markets are leading, and so they significantly outperformed during that time. But you can also see here, since that time period, really since 2011, U.S. stocks have significantly outperformed. But we're starting to get up to a point where you can see this red line here, where we're getting back to the point where prior to the last time emerging markets started to lead again, there was this kind of top back in 1998, 2001, where you only were able to outperform for a certain amount of time, and then kind of the pendulum swung back to the other way. So this is one way to look at it from a charting perspective, but I want to show you a lot of different angles so you can see why we believe emerging markets do present an opportunity over the next 5 years. So this is another graph, kind of like the one we just looked at. It's saying the same information, but it's going back a lot further. And you can see the purple area here, which is really international. It's not just emerging market. It's mainly international. And you can see the purple time frames are when international outperformed. The gray time periods are when U.S. stocks outperformed. And you can see that they alternate over time. And we're in this period where the U.S. markets have significantly outperformed for a long time period, one of the longest time periods, actually the longest time period in this chart, and 14 years. And so it doesn't necessarily mean that emerging markets are going to start to return better going forward. It just puts a higher probability that that will be the case as these kind of swing back and forth from outperforming each other over time. And we're at one of the longest time periods of outperformance in history for the U.S. stock. So now looking at just throughout history, if we go back a long period of time, all the way back to 1969, and what this does, and I know this is a little bit of a confusing chart, each one of these dots represents a 10-year time period. So rolling 10-month time periods all the way back through 1969. And anything above this diagonal line right here, so anything above that area, that's when the U.S. stocks have outperformed for a 10-year period. Anything below this diagonal chart is where international stocks have outperformed over time. In really throughout history, even after this 14 years of outperformance, U.S. stocks have outperformed 54% of the observed periods. And so it's about 50-50 in terms of the time frame of when international markets outperform versus U.S. markets outperforming. So, when we try to create or when we're looking for an opportunity as to where to invest or where to try to get additional returns or where to try to protect from certain areas of the market, we're looking at not only different sentiment indicators and different charting indicators, but we're also looking at valuations. And so this chart right here is focused on valuations. Excuse me. So on the left side here, we're looking at the price to earnings discount versus U.S. stocks. And for any of you who have studied statistics over time, right now we're at the third standard, or approaching the third standard deviation, which happens very rarely in statistical analysis. In terms of what that number represents is we're at a 32%, international markets are at a 32% discount compared to U.S. stocks. And so that presents an opportunity where, in terms of valuations, international stocks look really cheap, if you will, or a really good value compared to U.S. stocks in a valuation that doesn't come around very often. Again, does that mean that emerging markets or international markets are going to immediately start to outperform? No, it doesn't mean that that's going to start immediately, but it does put a much higher probability that that will happen over a long period of time. And so anytime we try to create a position or build a position, we slowly build it over time. And this is an area that we've been slowly building into. So the chart on the right here, also a valuation metric, where it's looking at the difference in the dividends. And when the dividends are higher, when the yield is higher than the US dividend yield, that is another valuation metric that's showing that there are good values internationally. And right now, we're at above the second standard deviation in terms of how much more dividends are paid internationally than U.S. stock markets. So another thing that points to good valuations. This is another valuation chart, and what this looks at on the left side here is global earnings growth. So you can see different regions here: U.S., China, emerging market, Europe, and Japan. And then you have 3 different years, right? 2020, 2021, and 2022. And you can see earnings went down a lot for most countries in 2020 when the pandemic happened, except for China. China actually had positive earnings in 2020. And then in the rebound in 2021, you had big rebounds for a lot of these countries, especially emerging markets in Europe. And now as we go into 2022, or as we're in, and we continue to go into 2022, the latter part of 2022, you can see kind of where the estimates are for earnings growth going forward. The highest one is China at 14%. US has the next highest, but emerging markets are very similar to US earnings growth. All that saying, at the same time, what we're pointing out here is that valuations are much cheaper in emerging markets, and in certain components like China, earnings growth is supposed to be higher. And even the rest of emerging markets in line are pretty similar to US stocks. So on the right here, what we're looking at is another chart that shows valuations. And it shows this horizontal purple line is showing the 25-year average of valuations in different parts of the world. And then the blue diamond right here is showing where valuations are at right now and looking at price to earnings ratio. So you can see the US right here is above that this horizontal line right here, which shows that it's overvalued, or it's valued above its long-term historical valuation. But if you look at Europe, you look at Japan, emerging markets, China, they're all either significantly below or right at their long-term valuations, showing that they are not overvalued compared to their history as opposed to the US. So I just wanted to give you a quick update on where the Ukraine and Russia crisis is and kind of historical context. And then I wanted to also point out on a lot of questions that we've been having about emerging markets and some of the hits they've been taking right now, and the reasoning why, the reason why we are investing in that area. And it's something that we believe over the long run, based off of different things that we're seeing technically from a valuation perspective, and even just looking at historically what's happened, we believe all these things are aligning to show that this looks like a really good opportunity as we go forward. But as is the case with our investment philosophy, we're always managing risk, and we don't ever want to get all into one position. It's part of an overall diversification that we have in our portfolios. But we do believe this is an opportunity going forward. Be on the lookout for our next quarterly update, and we'll go much more in depth on bonds and just the overall economy and the market and kind of where we're going into 2022. So I hope this helps. If anyone has any questions, feel free to reach out to us. Take care.